Steve is very interesting because he is one of the rare economists who predicted the financial crisis quite some time ago, starting from December 2005. And actually, his work on the possible crisis in the economic system dates back to 1995, where he showed that it was possible in the economy to have an apparent period of stability just preceding a big crash. And from 2006, he started a blog to explain that what was going to happen, why it was going to happen, and maybe what we could do about it. So I think that this talk is going to be interesting for you, maybe for something like 3 reasons. The first one is that Steve is questioning what is economics as a science, and apparently it's not what you read in the textbooks. And what you read in the textbook just has the appearance of the science, but is absolutely not something you could really call a science. And if you want to know why, again, you can read this. The second reason why it's very interesting to listen to Steve is that he has a strong focus on the banks and the role of finance, and we also what has been the role of finance in the recent crisis. And I mean, it had a real impact, and I think impact is a word we are very concerned with at NICTA. And the third thing is that if we are to do something about those crises, we need some science, we need some software, and science would be dynamic modeling, most certainly. So maybe taking some inspiration for physics systems or biology or weather. And then the software is something that is already started working on with Russell, who's here, and with an open source project called Minsky. So
thank you very much, Eric. Thank you. I'm delighted to be invited here, and I just might do a quick check. Has anybody here done an economics degree? One victim. And anybody done economics courses at all in their other degrees? A few. So you've had a bit of exposure to it. Well, how many of you thought what you learned was sensible? Oh, that's great. Oh, a couple. Okay, I thought it was garbage. Don't get much time for that, do I? It's obviously a biased questioner. Who thought it was garbage? Okay. Who doesn't really know? Right, okay, well I'm going to try to cover a bit of all that today. And what I'm going to start from is what actually happened to the economy, looking at the American data, which is I think the best data to use because it's the largest capitalist nation on the planet, largely self-contained, and you can't really blame its situation now on government policy, which you certainly can do with Europe's situation right now. So if you look at what was happening with inflation and unemployment, the red line being the unemployment rate, the blue line being inflation, right out to 2008, economists were congratulating themselves on what they called the Great Moderation. So they thought what you saw was a series of cycles where unemployment was peaking at a lower level each time, inflation was falling from up to 15% down towards about 3%, and they thought they could take the credit for that, and then 2008 hit and all hell breaks loose. Unemployment blasts up, and in fact, if we had the same definition of unemployment in 2010 as we had back in 1990, the unemployment peak would be about 12%. So unlike physical data, economics keeps on redefining what it doesn't like to make it smaller. A bit like the force of gravity would now be 0.3. We could jump from here to Central Station, no problem. But that's, in other words, a total breakdown has started to occur at that stage. Unemployment going through the roof and inflation turning very rapidly from about 5% inflation to minus 2% deflation, which we hadn't experienced any time in the post-war period. Now, it wasn't anticipated by the conventional models that economists use. The ones they use these days are called DSGE, which stands for Dynamic, Stochastic, General, Equilibrium. And I'd say it's neither dynamic nor general. So they're stochastic equilibrium models. If you imagine the old cross to supply and demand curves, each point on a DSGE model is one of those intersections. There's a shock, the next intersection, a shock, the next intersection. It isn't genuine dynamic in any sense of the word. But using those models, this is what actually not the vast majority, literally all of these models predicted back in 2007. I choose the OECD because its timing was so perfect and its statement was so bland. The current economic situation is in many ways better than what we've experienced in years. Our central forecast remains quite benign. They expected a soft landing of a slight slowdown in America, recovery in Europe, and sustained growth, strong job creation, and falling unemployment. That was 2 months before the crisis began. Now, the work that I do did anticipate this model for a number of reasons. And as Eric says, it goes back to 1995, because when I first generated this model as a generalization of a genuinely dynamic model of the economy, adding in banks and debt and money, it had a very bizarre feature, which I now understand the chaotic dynamics behind it, but it led me to finish with what I thought was a rhetorical flourish at the end, saying that we should not regard a period of stability as anything other than a prelude to a storm. Okay? And that was the final line. The chaotic dynamics should warn us against accepting a period of relative tranquility as a period of anything other than a lull before the storm. Now, the reason that I had that conclusion, which vastly differs from neoclassical economics, is that as well as looking at the inflation rate and the unemployment rate, I also look at the level of debt and the rate of change of debt. And that's what I've added to this graph now. So it's the same chart as beforehand, but now including on the right-hand side the level of private debt, not public, private debt compared to GDP, and the rate of change of that. And what you can see with the, I wish I had a point of work on the screen here, I don't think it actually does. Let's see. I can't bring it up. Okay. What you had was the brown line showing an increasing level of the rate of change of private debt. But the dotted line, the black line, is the most obvious one. That's a debt ratio that was back in 1980 was roughly 140% of GDP, and by 2008 was about 280% of GDP, doubling over that period of time. And the brown line is the key giveaway. That's the annual change in debt as a percentage of GDP, peaking at about 20% and falling down to minus 30%. So that dramatic, first of all, growth in debt and then collapse in the rate of growth of debt, that's what I was expecting to have happen, and that's what caused the crisis. Of course, that's actually left out of conventional economic theory because they ignore banks, debt and money. So to compare my approach to the standard neoclassical approach that dominates economic teaching, for a start, I meant non-equilibrium modelling. Neoclassical economists have this belief from the 19th century approach to modelling that you can only model a system in equilibrium. Now that's so naive from a modern dynamic systems point of view, but that's what they actually believe. And in fact, their DSG models assume their equilibria are stable, even though what they've got is what we call a saddle node equilibria. So what they get to explain the fluctuations, they assume this thing called a rational agent, which we all are, can spot this Lebesgue measure of zero, saddle, jump onto the saddle somewhere, and we wobble our way down towards the bottom of the saddle, and that's where they get their fluctuations from in their models. Incredibly backward. Completely locked out from modern dynamic modelling. So I start from saying we have to have the capacity to model in and out of equilibrium, and the stability of equilibrium is determined by an analysis, not by assumption. And this is Minsky himself writing back in the 1970s saying stability or tranquility can itself be destabilising. And when they talk about rational expectations, what they mean by rational is the capacity to accurately prophesise the future. When you look at how they define rational, that's what it means. You can accurately predict the course of the system makes you rational. If you can't, you're irrational. That means by definition all economists are irrational. I'm trying to convince them of that one. Minsky talked about euphoric expectations and saying what happens is people extrapolate current conditions forward, as they're doing right now in the American stock market, as you can see, and in that process they end up accepting levels of debt that in a more sober climate they would have declined. And complexity and emergent properties at the basis of the system. Neoclassicals believe you must model the economy by aggregating up what individuals do. But they've proven you can't do that, so they assume there's only one individual and aggregate that individual, calling it the representative agent. Now, they've mathematically proven that can't be done. There's actually a wonderful proof by contradiction that they don't realise is a proof by contradiction, but that's what they do. So this is just showing that it is a proof by contradiction. To actually go from a single individual with what they call a demand curve that obeys what they call the law of demand, to get to the aggregate level, they assume that you can have a single individual who represents the entire economy. Now, in doing the mathematics, the question, can that actually be done, this was the conclusion of the lead authors, that every polynomial, and anyway, can be an excess demand function. With any curve you can draw, squiggly line that doesn't cross back over itself and doesn't return two values for any one input is a feasible demand curve. And that breaches the law of demand. So they prove that, and then they ignore the result, or they reinterpret it saying, oh, therefore we can use a single individual to model the entire economy. It's simply mathematically false. And in terms of production technology, they emphasise this thing they call diminishing marginal productivity. Any farmer or any manufacturer who managed a firm according to neoclassical theory would go broke. That is not a sensible way at all to model production. In fact, when you take a look at what firms actually do and you compare it to neoclassical theory, you find that 85 to 95% of firms, when they look at what neoclassical theory says is the way their costs are structured, say that's not us. And yet that's what they teach students is the norm. So all that goes out the window from my approach to modelling. And also a key issue here is the role of money. The neoclassical theory argues what they call the money multiplier theory of money creation, which has banks effectively being warehouses under the control of the central bank. Now, my point of view is, and this is empirically based as well, they're factories. They produce money by double entry bookkeeping. And you then look at the data. Again, the data confirms the position that I take. And then the government, the neoclassicals regard the government as being necessarily destabilising a stable system or making a stable system behave less well. They don't believe any about instability. But what you find from Minsky is the argument that what government does is it might do stupid things with its money, pink bats and all that sort of jazz, as we know in Australia, but its money is spent and people get income they can then go and shop with, which enables firms to pay their debts in a way they wouldn't be able to do without the government cash flow. And again, non-equilibrium models are what we use overall. And again, you'll find occasional glimmers of this in economic theory when a crisis hits. This is Irving Fisher, who gave us the debt deflation theory of Great Depressions, but before that gave us the conventional theory of finance and talking about why he got it wrong, why he didn't see the crisis coming back in the 1920s. His argument was that he made the mistake of assuming equilibrium. He said even if you assume everything tends towards equilibrium, disturbances will mean every variable is above or below its equilibrium value, and therefore to model you must be working in non-equilibrium. So this is Minsky. That's the background of what I do with Minsky. I find Minsky's, the reason I call the software package we're now working on Minsky is because I think he philosophically brings all this together in the best possible way. So his model starts with an economy in historical time. I emphasise those two words because neither history nor time are part of neoclassical economics. It's all equilibrium, and they leave out the historical record. In fact, I've seen over the last 40 years, while I've been in economics and 20 years as an academic, watching economics departments actively shut down economic history courses. Now, of course, universities are shutting down economics degrees. Great. So you started in the past when there's been a debt-induced recession. And because of that recession, both firms and banks are conservative about debt levels, and therefore only conservative projects get funded. But because the economy is now recovered, most of those projects succeed. And therefore firms start to revise their risk premiums, increase the amount of debt they're willing to consider, and they start to revalue assets more highly. And that's the stability is destabilising process. So a period of tranquility causes rising expectations. Rising expectations lead to growth. Now, initially some of that is good because with less risk aversion there's more investment, and the investment makes the economy grow more rapidly. But ultimately you get to this point that Minsky called the euphoric economy. And that's where people think happy days are here again, prices are always going to rise, let's borrow money and go and gamble on asset prices. Banks are quite willing to lend to finance that. That expands the money supply, which partly validates the risky investments, but of course most of those are losing money. It's a net to zero game. Just to try to get rich by selling second-hand shares or houses to each other is a net zero game. You're paying interest to do it. You're actually accumulating losses over time. You finally get what he calls Ponzi speculators, people whose cash flow is less than their debt servicing costs. The only way they make money is by selling assets in a rising market. But if that rise stops at any point, they are bankrupt because they have always been technically bankrupt. And they drive up the demand for money, they drive up the cost of money as well. Now, ultimately, a combination of those various factors means you hit another crisis. A lot of projects which were conservative are now risky because of higher rates. They might try to liquidate. There's all sorts of mechanisms that lead into this, and accumulated losses by Ponzi's as well. Simply a slowdown in the rate of growth of the asset prices is enough to bankrupt them. So that starts to happen. The market collapses, and you're back where you started from. You're back on a bus once more. And the Ponzi's are the first ones to fold because they can't sell for a profit anymore, and they can't service their debts to begin with. Asset prices collapse. The expansion of the money supply goes into reverse. Investment evaporates. You're back where you started again. So it's a classic cyclical model in that sense. And it can repeat again when the debt levels fall a bit, but there's a ratcheting effect going on here. Basically, you borrow money during a boom, you have to repay it during a slump. And what will then happen is a ratcheting process where the debt level rises over time. And you can reach a level where ultimately so much debt is taken on, the economy can't service it, and you fall into a total collapse. Now, that's Minsky's verbal model, and what I've been doing in my research is turning into a mathematical one. So the simplest model is to start from what's called Goodwin's cyclical growth model, which is a structural model of how cycles can occur in the economy. So it's, if you do a measure of output and a measure of capital, there's a relationship between the two that's relatively stable that economists call the accelerator. That I've given to relate capital stock to the level of output. With output, you can work out how many workers you need to hire given labour productivity. The level of labour employment determines the rate of employment, and that rate of employment is an argument in how fast wages change. Not the only one, but a clearly important element. How high unemployment is a guide to how much wages may rise or fall. Subtract wages from output and you have the profit level. And in the simple model that Goodwin put together, he said all the profits are invested, which of course means negative investment on occasions with a linear relationship as well as positive ones. And you put it together in the system of ODEs, and you get two system states, the employment ratio, which is lambda, and the wages share of output, which is omega. And out of that model, you will get cycles. Now, I'll put this together and show it in our Minsky software. He says tapping and praying it'll start. Great. Pardon? Sorry, thank you. I'm very, very bad hearing. pH stands for the Phillips curve. So it's the relationship between employment and the rate of change of wages. I'll see if I can load that program directly in Minsky itself. Let's see. I hope I have it available. Oh, that might be it. Let's see. Okay, this is not as good a simulation of the Minsky model as the one I had embedded there, but what you get out of the system is cycles. Okay? And basic reason, the eigenvalue, the dominant eigenvalue is a complex with no real parts, so you get a fixed limit cycle like so coming out of the model. Yeah. There's no nonlinearity in the system at all. The nonlinearity comes out of multiplying the wages, which is a variable, by the level of employment, which is a variable. So it's a structural nonlinearity. And it's a simple structural model. People often think this has been imposed by stealing predator-prey models for economics. No, it just really arises out of talking about the structure of the economy. So when I add nonlinearity to the system, it actually gives you more realistic cycles by limiting, not having negative investment and so on. That's the impact of bringing in, the blue line is the impact of bringing in a nonlinear relationship between employment and wage change. The black line is nonlinear investment. And that's because the black line is getting closer to a realistic level of the actual values in the economy, even without an attempt to fit parameters to it. Now, what I did was add debt to the whole system. Simply saying when capitalists want to borrow more money, want to invest more money than they have in retained earnings, they borrow. When they want to invest less, they pay their debt back. So a simple equation like this, saying the rate of change of debt is investment minus profits, was all I added to the system. And what you now get, for the people in this room, you'd know what I'm talking about, is a three-dimensional system. Rate of employment, wages share of output, and the debt-to-output ratio. And that means we pass from where you can't have chaos and complexity to where you can. So a system of ODEs, slightly more complicated. And of course, the Lee-York theorem, period 3 implies chaos. Once you have 3 or more system states, you can have chaotic behaviour rather than a fixed limit cycle. And the actual route that it follows, this is why I now know its behaviour, is the inverse tangent route to chaos. So you have convergence to equilibrium for some initial conditions and some parameter values, but in others, there is no equilibrium. You pass through that narrow channel and end up in chaos. And that's what happened when I simulated it empirically. So this is when I had a set of parameter values and initial conditions that gave convergence. And what you've got in the horizontal axis are wages share of output and the employment rate, and the vertical is the banker's share of output, which is just the interest rate times the debt ratio. So that's a good situation. That's a good equilibrium. This is the bad one. Now, if you're only following the projection of that on the x-axis, what you see is stability. The great moderation is approaching. When you add in the third dimension, you think, holy hell, all hell's about to break loose once we get through that apparent narrow channel. And that's indeed what happened. So there are two equilibria, a good one with positive incomes, positive employment and finite debt, but a bad equilibrium with zero wages and profit share, zero employment, but infinite debt. Now, of course, we don't get to that point. This is talking in a system where there's no bankruptcy, where there's no government bailouts, etc., etc. All those things are extra elements of reality you have to include. But technically speaking, this is the black hole we've fallen into through this financial crisis we've gone through. Unless we do something to reverse it, that's the outcome. And a colleague of mine, Matthias Grasselli, who's the Deputy Director of the Fields Institute in Toronto, has now got heavily involved in analysing this model. And what he has found is that the basin of working at the basin of attraction, the Lopinov exponents, etc., of the system, and what destabilises and restabilises the system. And if you have speculative investment, borrowing money to gamble on asset prices, that means you have zero basin of attraction for the good equilibrium. But if you eliminate that, you have a positive region around it, which you can expand by government spending. And that's where I'll bring in I'll start to hand over to Russell in a moment. This is showing the region of stability for the private sector model only. That's a function of the initial conditions for the income share of workers, the employment rate, and the vertical axis, the rate of interest. And the higher the rate of interest and the higher the debt level, the smaller your cone of stability is around the good equilibrium, the more likely you are to fall into the black hole. Now, how do you get out of a black hole? Well, there's two answers to that question. One, you don't. And two, you might if it's a spinning black hole and you get Hawkins radiation. Well, and you can see bankruptcy as being a similar event to that, reducing the scale of the black hole that way. But we can also reduce the force of gravity in the situation by dropping the interest rate, which is what we've done. Of course, the negative that can happen out of that is if deflation hits, as it did back in the Great Depression, the real rate of interest can actually rise. And back in the Great Depression, the real rate of interest hit 13%. Because the nominal rate was 3, but the rate of fall of prices was -10. So what can actually also prevent you getting there is government spending. This is not saying government spending is sensibly done. It's simply another source of cash into the economy that enables debt levels to be repaid, and also hopefully taxes that stop speculation. But I think I'd be a flying pig before I said that happened with our current government systems. Now, I bring the government system in here by simply having government spending being a function of the employment rate. And what I show is a government that steadfastly holds the line against rising unemployment. No such government exists. Okay, we've all seen them modify that the higher the unemployment rate gets, the more they accept a higher level of unemployment. But when you bring it into the model, what you get is a four-dimensional system, including government spending as part of the argument. And what you get out of it is, if it was my colleague Matthias puts this beautifully, it destabilises a stable equilibrium. You don't want to be in the black hole. Well, it makes that unstable mathematically. And you can therefore move from the bad equilibrium to the good one with a big enough stimulus. What you get out of the system is cyclical behaviour, not stability, as neoclassicals define it. So neoclassicals seem to believe that the absence of cycles is a good thing. With a richer vision, what you see is that cyclical behaviour is the norm in a complex system. And what you want is not to prevent cycles, but you want to prevent cycles that lead to total breakdown, total terminal behaviour. This is now simulating Minsky in our program Minsky. I'll let Russell to talk in a bit more detail about that, but as you can see, this is pretty much emulating what you can do with Simulink or BizSim or iThink or Stellar or all the other systems dynamics program. We add something new, which I'll talk about in a moment. What we're trying to do is to build monetary macroeconomics. Now, again, that might sound bizarre to people that haven't done economics in the room, but neoclassical economists believe banks, debt and money don't matter in capitalism. I believe it's a bit like believing wings don't matter on birds. You know, it's incredible that they believe you can do model capitalism without it, but they do. They've taught themselves a form of Kool-Aid that argues that proposition. Now, we argue precisely the opposite. If you don't have banks, debt and money in your model, you're not modelling capitalism. So we're trying to build a framework that lets you do that, and let us consider the impact of inflation, deflation and so on, and consider the capacity of banks to create money as part of the overall system. And what I realised some years ago was that that's really hard to do in a flowchart program like that. I actually worked out a model in differential equations once, and I was trying to present it in a flowchart with a dynamic simulation at a conference, and I kept on stuffing up. Like then putting minuses where I should have pluses on various links, and didn't cable up the right wires and so on and so forth, and I never got it done. But I realised if we simply borrow what accountants use, this double entry bookkeeping approach they use to keep track of financial transactions, and then generate the equations out of that table, I could maintain the consistency you need to have between the different accounts and generate a model of monetary creation. So that's what I've done. And of course, in doing that, I've got to have a model of prices as well, the dynamic pricing model. Wages, the relationship has to be a monetary one rather than the real one I showed you earlier. And what I ended up ultimately, and I'm going to flash for this in the interest of time, is a model that generated a more realistic version of what we went through in terms of the actual causal pattern, because what I showed you beforehand didn't have any price dynamic to it. What economists focus upon is employment and inflation. So I needed to have prices inside there as well. Now, it ended up being a fairly complicated model. It's about 11 differential equations in the system. What it generates, and this is without trying to calibrate the model at all, the red and the blue lines are inflation and unemployment again. The black line is the debt to GDP ratio. And you can see the same basic characteristics there that we saw in the real data. Declining cycles in employment and inflation, if that's all you're looking at, everything's hunky-dory. Exploding debt. And then when it finally hits, the whole system collapses. Now this is the American data. It's looking at smooth American data over the last 20 years or 30 years. And, you know, if I get that close without even bothering to try to fit the parameters, I think I've got a qualitatively matching model to what actually happened in the real world. And also, it's because of the nature of the equilibria, if you're just focusing upon the rate of profit, you're not going to find anything is wrong until the system collapses on you. And this is just a simulation of that. That's the blue-red line of the profit rate. Nothing wrong at all. And then, holy shit. So again, you've got to have an understanding of the dynamics to know what's going to happen, what you can get out of it. So I'm now trying to build an overall platform for that, which is builds into the system dynamic software like you can see here. I'll just stop the simulation and add the icon. There you go. We can add a banking system here. And, pardon me, I'm trying to double click, okay, and bring up a tabular view where the elements that you add into this table will generate a system of differential equations in the same way that integral blocks do that in the flowchart system. And I'll just very quickly jump a bit further. I want to give plenty of time for Russell here, so pardon me jumping on a bit. Okay. I'll let Russell go through this part here. But what we're aiming to get to ultimately is the capacity. I'd actually simulate this. I'm trying to find if I get there, let's see. Yeah, okay. What we're doing so far is a scalar version of the economy. The ambition is to go to multi-sectoral. And just to show that it can be done, I did this before I built the Minsky approach, after I built the idea of building a tabular system for putting the whole system together, but before we started writing the Minsky software. So I've actually built a nonlinear, monetary, multi-sectoral dynamic model of the economy, and I chose a set of random parameter numbers for the simulation. I did this with a CSIRO. I remember vividly going into the room to say, okay, I'm going to hit the wrong button, it's got to crash. You know, what are the odds with a system with 41 nonlinear differential equations? What are the odds of choosing a random set of parameter values and a random set of initial conditions to actually get a cycle? I'm bound to get into the region where the system breaks down. And I came back and said, well, that was easy. So I've captured something about the inherent instability of a multi-sectoral production system by doing this. Our ambition is to get to the stage where that is easy to do in the Minsky software. And a very, very quick conclusion here. We need to get this technology extended. So what we're doing right now is running a Kickstarter campaign to try to raise money to keep Russell coding. And any people who help out an open source would be delighted. Please come on board. But I'll hand over to Russell now to talk about Minsky itself. Thank you.